Hi there. This is Mark Brantley of Boardroom Minutes. Our topic today, boards don't just approve the numbers, understand them. And that's very important for every director that sits on a board. But before we get into our topic, welcome back to Boardroom Minutes, your premier channel for clear, concise insights into the issues that shape today's boardrooms at for profit corporations, nonprofit corporations, and religious institutions like churches. Here's a truth that every board member needs to face, and that is you can't lead what you don't understand. And that includes your organization's financial statements. You don't need to be a certified public accountant to serve on a board, but you do need to know what you're looking at when those financial reports hit that boardroom table. And today we're going to break down in plain language how to read financial statements as a board member. Now, this is not a course in accounting. This is not a course in banking, but this is just a plain language primer on how to handle and read financial statements as a member of your board. And by the end of this episode, what we hope to accomplish is for you to have a basic understanding of what to look for, what questions to ask, and how to spot red flags before they become a big problem for your organization. But before we do that, why don't you hit the like button? Or if you're not a member yet, or rather a subscriber as of yet, why don't you hit the subscribe button? Or if you prefer to wait until after this episode, and if you find it beneficial, then why don't you like it at that point and then also subscribe? All right. So our topic today again is boards. Don't just approve the numbers, understand them. And what we want to first look at is the question, why does financial literacy matter for every board? Well, every board, whether it's a corporate board, nonprofit board, credit union board, bank board, or even a church board, is responsible for that organization's financial oversight. The board doesn't manage the daily books, but it must make sure that the organization is financially healthy, transparent, and compliant. And if you don't understand the numbers, then you cannot fulfill your fiduciary duty, namely the duty of care. And what is a key takeaway here is you don't have to prepare the statements. That's for management to do. But you must be able to read them and ask the smart and right questions. There are three major financial statements, let's call them the big three, that you need to know and be familiar with. And the first is the balance sheet. That is, in essence, what the organization owns and what the organization owes. It's a snapshot in time with regard to the financial picture of the company's assets, liabilities, and net worth. What are the assets? Simply what the organization owns. It's cash, it's property, it's investments. What are liabilities? It's what the organization owes. That could be through loans, it could be through accounts payable in which you owe companies for purchasing their products, or just unpaid bills. Those are liabilities. And then, of course, net worth is what assets are left after the liabilities are paid. And it's always that key formula in looking at the balance sheet, which is assets minus liabilities equal net worth or equity. And that is what the organization is worth after all the bills are paid. So you need to be familiar with that financial statement, the balance sheet, because that is one of the top three financial statements that you need to exercise with respect to your duty of care. And you need to ask these questions of management after you review the document. Are assets growing or are they shrinking? Are we too dependent on debt? Is there enough cash on hand to handle a crisis? Do we have reserves? Is there enough cushion, in other words? So, those are some of the questions that you need to not just ask management, but first ask yourself when you're reading your balance sheet. And then the next big financial statement is the profit and loss or income statement. That lets you know how the organization is performing. This shows how money comes in and goes out over a specific period of time, like a monthly report, a quarter, or an annual period of time. And what we look at with regard to the financial profit and loss statement, that is revenue, which is all income. That's income from sales. It could be incomes from donations. If you're a charitable institution, if you're a church, it could be income from your tithing, your offering. If you are a financial institution, various fees that are charged, that is all income or revenue. And then expenses are, in essence, the things that you spend the organization's funds on. They're the expenditures, things like salaries, rent, insurance. Those are the expenses that must be expended in order for the organization to operate. And then there is net income. That is the bottom line of the organization for that particular period of time. In essence, there will either be a surplus or deficit. There will either be profit made or there will be a loss. At any event, it is that number that is left after you deduct expenses from your revenue. And after you review that profit and loss statement, you need to ask these particular questions. Are we bringing in more than we spend? Is our revenue more than our expenses? Are we running a deficit? Are expenses in line with our plan? Because what you spend money on must be in alignment with the mission, or else it's an unnecessary expenditure. So you have to look at your expenses to see whether they are in alignment with the organization's mission. And then, are there any surprise increases or decreases? Even on the revenue side, if there's a certain spike in revenue, we need to know why. If there's a certain spike in expenses, well, why are we incurring additional expenditures during this period of time? Also, decreases. Why are there significant decreases in revenue or expenses? And then looking at the bottom line and comparing it to other periods. So that's an important analysis when we look at that profit and loss statement. And then the last of the big three financial statements is the cash flow statement, where the cash really goes. This statement details a company's cash inflows and outflows over a specific period. It reveals the company's financial health and its ability to meet obligations. It's broken primarily into three sections. That's cash from operations, which is typically the core business activity of the organization. Then cash from investing, um, investments in equities or in equipment or real estate. And then there's cash from financing that deals with debt and equity. And this together shows how cash is generated and utilized by the company. And it helps to assess a company's liquidity because it's very important to have cash on hand in terms of tight spots and crisis. It also helps to assess operational efficiency for the organization, overall financial stability, and indicating whether the organization can pay its bills, whether it can invest in growth, or generate enough cash to sustain itself without needing to get external funding, without needing to get external loans. You can have a company that's very profitable on paper, but it can still run out of cash. And it's important to have, especially if it's a credit union or if it's another financial institution, because you need to meet the demand of your members when they want to withdraw their funds. It's not just enough to make profit, but you also have to meet cash flow demands. And when it comes to these big three financial statements, I would say the key takeaway is to view these statements as position, profit, and cash flow, because together in harmony, those three financial statements, they tell the whole story with regard to the financial condition of the organization. And what smart boards look for are: one, they look for trends, not just numbers. You have to compare this quarter's results to last quarter's results, or even the month or quarter of the previous year. You also need to ask, is this type of trend or direction financially healthy? Number two, you need to watch for red flags. We talked about it in terms of sudden revenue drops or certain expenditure spikes, and or shrinking cash reserves. These are all red flags that you need to be aware of. And if something looks askew or off, then you need to ask management why. Three, you need to ask for clarity, not detail. In other words, don't get lost in the accounting terminology. You want it to be made plain and simple so that you can understand what you are reading. And instead, rather than accepting what a variance is, why don't you just ask, well, can you explain what a variance is in simple terms? Can you explain why this difference in last quarter is different from this quarter? Those are the simple questions that need to be asked to get profound answers. Then, four, you need to focus on sustainability. It's not just about today's balance, but it's about whether the organization can last long term, because you don't form an organization for a short term period. You want it to be sustainable over the years, over the decades. And in order to monitor whether the organization is sustainable, you need to be able to read the financial statements. Now, let's look at the board's role in financial oversight to sum things up. As a board member, your financial responsibility isn't to balance the books. That's for management to do. But you must ensure that the books balance with the mission. We talked about that. Are you expending? Are you spending money on things that are in alignment with the mission? And that's balancing the books with the mission, not balancing the books just with regard to creating the financial statements. And that means reviewing the financials before meetings. It doesn't make sense for you to sit at a board meeting looking at the financial statements for the first time. You must review it. And sometimes you must review it a second time so that you are prepared to ask the right questions. And that goes into asking those good questions, asking the right questions, and not just approving the reports, not just being a rubber stamp, because ultimately the buck stops with the board. You are the governing body by which the organization receives its direction. Also, you need to make sure management follows through when these issues are spotted. In other words, you need to get the right answers. And if the answers aren't provided at the meeting when the question is raised, then you need to make sure management follows through to provide that answer, that response on a timely basis and in a timely manner. Also, you need to ensure that the organization has an annual audit, not just an internal audit, but also an independent review. You need to have an external company or organization review the reports you're receiving. You see, when it comes to certain fiduciary duty statutes, yes, they give you the wherewithal and the latitude to rely on management's financial statements. But that doesn't mean that you have to accept every financial statement that's put before you. That's why you need another set of eyes to review those statements for you to make sure that they are up to snuff. In other words, there's a saying that says trust, but also verify. So it's good to have an independent review from an outside auditor. And even when it comes to independent reviews, you need to, from time to time, switch up on those companies that you are contracting with that are reviewing your financial statements. So, in essence, you don't have to be a CPA, but you do need to be curious as a board member. You need to be consistent in your approach to reviewing these financial statements, and you need to be courageous and not fearful of challenging where necessary certain things that may not look appropriate, because again, the buck stops with the board. I think we're going to end there. And I thank you once again for joining in Boardroom Minutes. And I hope this primer on financial statements was beneficial. And again, if you haven't liked the episode yet, if it was beneficial, why don't you do so? Also, subscribe. Again, this is Mark S. Brantley, Boardroom Minutes. Hope to see you on next week. Bye.